Financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
Friends, welcome to Follow the Money Radio. So grateful to have you here along for the ride. As you heard, my name is Jerry Robinson, and today we're going to be talking about the stock market. We're going to be talking about the broader financial markets. I have a few things I want to talk about today. I want to get right to it. I first of all want to welcome you to 2022. We are finally here. We have made it 2022, a brand new year. And as New Year's go, oftentimes investors will discover that January really sets the tone. And as you notice from today's podcast title, today we have titled this podcast, The January Barometer. And the January Barometer is summed up in a simple, single, easy to remember phrase that says, as January goes, so goes the rest of the year. This is a market phrase, a market adage that was devised by Yale Hirsch back in 1972. And we've talked about Yale Hirsch before. He was the founder of the Stock Traders Almanac. Jeffrey Hirsch is his son who carries that on. We're friends with Jeffrey Hirsch. We speak at the Money Show, run into him a few times. And Mr. Hirsch continues the work of his father. In fact, I really encourage most people to check out the Stock Traders Almanac if you've never seen it. If you're into stock trading, it gives you lots of really interesting statistics about how the market performs, you know, throughout history on certain days, in certain months. Well, again, there's this idea called the January Barometer. As January goes, so goes the rest of the year. So since 1950, the so-called January Barometer has been right more than 80% of the time, according to the Stock Traders Almanac. And so in essence, if the S&P 500 closes the month of January up, then that means, historically speaking, using this data, that more than likely we're going to see higher prices by the end of the year in the S&P 500. So that's interesting. So too, the performance of the S&P 500 during the first 5 days of January also tell a story about how the rest of the year could go. According to the Stock Traders Almanac, the last 44 up first 5 days were followed by full year gains 36 times for about an 82% accuracy rate. And then you also have what Hirsch calls the January Trifecta, which includes not just the first 5 trading days of the new year and the January Barometer, which takes into account the whole return of the entire month, but also it includes the so-called Santa Claus rally. And when all three of these indicators are working or operative, whenever we have all three of them giving us a bullish signal, the S&P 500 has risen about 90% of the time with an average gain of about 17%. That's according to Hirsch's data. So we're recording this podcast on the 5th day of January, and right now the S&P 500 is up barely for the first 5 days, so indicating that the market may be moving in a positive direction according to this January Barometer, and we'll just continue to watch it. I think if you're a trader, this is something to know about. Again, consider checking out the Stock Traders Almanac if you've never read it before. It's really interesting. Lots of great information in it. So check out the January Barometer, and let's see if it holds true this year. Now, when you look at what happened in 2021, I just want to briefly talk about a few things here. Plus, I have a stack of news I want to get to. I want to talk about a few things. But first of all, when you look back at 2021, what an amazing year for stocks. I mean, overall, the S&P 500 was up around 27%. Tech mega caps had a big year. Apple, which is the largest corporation in the world by market cap, briefly crossed the $3 trillion level. So we've never had a corporation that was, valued at $3 trillion by market cap. And we did briefly just the other day with Apple. So that was astonishing to see. And when you think about Apple, it's really incredible because if you just go back to say 2018, Apple wasn't even worth $1 trillion. And so they have accelerated incredibly. So Apple navigated the pandemic in a way that is very impressive. Now, you may know from the last podcast we did the episode we called 3 Forever Stocks. I own Apple. I see the company really, performing well. And you can go back and listen to the last episode where I talked about why I like Apple. But Apple did very good. It had about a 36% rally last year-to-date gain. So it outperformed the S&P 500 with the 27% gain. It also outperformed the NASDAQ Composite Index, which was up about 23%. So Apple's got a big year coming forward. We'll talk more about Apple maybe later on in the future. Microsoft also had a great year. Its stock was up like 54% last year. It's the second largest company in the world. Microsoft is edging closer to Apple. Microsoft has about a $2.5 trillion valuation versus Apple, which is just right there at the $3 trillion valuation. Alphabet shares, or also known as Google, they were up around 65%. And in fact, Google, their stock was the number one Smart Score ranked stock here at Follow the Money for almost the entire year. In fact, I think it was the entire year. So our number one Smart Score ranked stock was Google all year long. And for those of you not familiar with our Smart Score ranking system, we use 7 fundamental criteria, and we rank all stocks in the U.S. stock market according to that. And Google was on the top of the list all year long, and it turned out that it had a great return, 60 some odd percent. Amazon was the laggard last year. Year-to-date gain of, I think it was just barely positive, maybe just around 5%. I don't have the exact number in front of me. So Amazon also facing some challenges this year. Jeff Bezos is going to be stepping down as the CEO. They've also had some other issues as well. Concerns about the acquisition of the movie studio MGM, all of this. And then you also have Tesla, which Tesla did really well last year, 50% plus gain. Most of that came in the last half of the year. And, the company seems to be really growing quickly. Tesla is very well positioned. And I think Tesla, which is not currently in the top 3 by market cap, not even in the top 5, I don't think, could move into the top 5 this year. I think that's a possibility because it's growing so rapidly. So I think, Amazon.com, Alphabet, Microsoft, all these FANG stocks, many people are familiar with them. They've all had a great year. As I mentioned to you also, we've had some other moves as well. Like, for example, we saw a big move in Ford stock this week as the company reiterated its commitment to EVs, these electric vehicles. And it's trying to keep up with Tesla, but it's just miles and miles behind Tesla. Tesla is so far ahead of the game when it comes to EV technology. And so Ford popped pretty nicely yesterday, or this week. Shares hit a 2-decade high. Highest level we've seen in 20 years for Ford. Why? Because they're raising their plans for the Ford F-150 electric pickup truck. So that's not too terribly surprising to see that the market is reacting well to that. Electric vehicles are just here. They're here to stay. Many people don't believe that it's real, right? But we're going to see in the next several years, if it hasn't already hit your market, you're going to see these electric vehicles from all different brands on the car lots. And it's going to be a really interesting time in the world of automobiles. I'm no expert in that space, but we also saw in the automobile space, for example, Toyota overtake General Motors as the best-selling automaker in the United States. So Toyota now overtaking GM as the top automaker in the U.S. That's really quite something, isn't it? That almost just speaks immoral or something. I don't know. It's just strange that there would be a foreign car company that would be dominating even over our own domestic car makers. Also, just a few other things here as well. We did see workers quit their jobs at a record level in November. We just continue to see this worker exodus. They're calling it the Great Resignation. People just feel like they have the opportunity to find another job, maybe a better job. Maybe they find better pay. So, it's somewhat understandable that there are a lot of workers in transit right now looking for better opportunities. But that was a really interesting thing that happened. And that also perked up the 10-year yield, which hurt tech stocks. So when the 10-year yield perks up, that's going to put pressure on growth stocks, but particularly tech stocks. And that's why we're seeing a little bit of softness in tech right now, as we enter the new year. And even we've been seeing that weakness in tech for a little bit, kind of lingering. A lot of it had to do with the Fed's, the pivot that they had made to begin doing 3 rate hikes in 2022 and to begin, tapering, doubling their taper as we had talked about recently. But then also there were fears over the Omicron impact from this new variant of COVID-19. And it turned out that this Omicron variant is just not turning out to be what many people had feared. That's why we're seeing oil prices, for example, jump. Energy is back on the move higher. OPEC sees a limited Omicron impact. And so producers are not too terribly concerned about it, or at least as concerned about it as they were in the recent past. So that all of that bodes well, I think, as we move forward. There's a lot of things that we can talk about. And in fact, we just released, for all of our new members, we just released a really cool 3 new services, I should say, not just one. We released a brand new ETF leaderboard, which tracks 150 different ETFs and keeps our members focused upon the hottest markets right now. So, if you're a trader or you're an investor and you're wanting to stay focused on the hot markets, the ETF leaderboard, a new service for all of our members, gold, platinum, and silver, really exciting service there that we've just released. Also, we have a brand new Smart Score 11 list. These are the top ranked stocks within each of the 11 stock market sectors in the S&P 500. So the top ranked stocks from each of those sectors. And that's a really interesting one. We're going to be rebalancing that one every quarter, and lots of that. So we, in fact, just recently released a very cool video on that topic of the Smart Score 11 for all of our gold and platinum members. And then also we released a brand new crypto leaderboard. This is exciting as well for those of you who are crypto traders or crypto investors. This one is very exciting. The crypto leaderboard focuses our members, gold and platinum members now, for the crypto leaderboard to have access to this. But every week we rank the top 50 plus cryptocurrencies, based on size. I mean, obviously the biggest ones, the top 50 largest cryptocurrencies. We rank them according to our own trend ranking. And so then we highlight the top 3, just like with our ETF leaderboard. We provide charts and commentary on the top 3, and then the rankings are there for you to do research on. And then we also have a new crypto report, a new PDF report that goes out every weekend to our gold and platinum members. So lots of new services here at Follow the Money. If you're new to Follow the Money, if you're listening to our podcast for the first time, you say, I'm not familiar with this podcast, you really want to check out our website, followthemoney.com. Check out what we have. We have lots of great resources there for you to check out, lots and lots of podcasts episodes in our archive. And we have a few different podcasts as well. We have a stock trading podcast. We have this Follow the Money podcast. We also have other podcasts that you can check out. But followthemoney.com is a great place to start. And if you want to become a member and really make 2022 a profitable year, check out our plans and pricing. Go to followthemoney.com/join. So 2021 was also a great year for commodity investors. Commodity prices soared in 2021 thanks to the massive money printing and supply bottlenecks and surging demand from consumers and producers. And when you look at commodities, I mean, coffee prices, hit a decade high after doubling in 2021. Sugar prices hit a 5-year high last year. Lumber prices hit an all-time high. What a wild market lumber has been. And prices are still currently around 60% higher than they were, this time last year. Oil, natural gas, ethanol, and gasoline prices all rallied strongly on the year. We had this, global energy demand that was soaring. Wheat prices rose more than 20%. They hit a new 9-year high. Oat prices nearly doubled and hit a record high in 2021. Then you had canola oil up 66% year to date, heating oil up 58% year to date, cotton, copper, corn, and live cattle, all up more than 20%. In the case of cotton, up 44%. So we actually anticipated this massive commodities rally in 2021. In our FTM podcast, we put out the episode entitled The Coming Commodities Bull Market. I forget the episode number of that, but you can go back in our archives and listen. We released that back on December 23rd, 2020. So it's been about a little more than a year ago. The one thing that was strange about the overall commodities rally, can you think of it? What was it? It was strange, wasn't it? It was the fact that all of the commodity prices pretty much went up, except for what? Except for precious metals, right? So all 4 precious metals had annual price declines last year, right? So gold was down around 3.5% for the year. Platinum was down, around 10%. I can't remember the exact number off the top of my head here. Silver was down around 11 some odd percent for the year, and palladium was also down big. Biggest loser of the year was palladium from the metals, and it was down, around 20% year to date, somewhere around there. And this disconnect between the annual returns for precious metals and most other commodities is certainly puzzling for some investors, especially when you consider that the official U.S. inflation figures recently touched at the highest level in nearly 4 decades, right? And so despite the current raging inflationary pressures, many investors have instead focused on the Fed's plan to battle inflation through an aggressive tapering strategy, along with the possibility of 3 interest rate hikes in 2022. I still suspect that we're going to see a rally resume in precious metals. And I say resume because the uptrends are still intact, long-term uptrends intact on gold and silver, and even position uptrends as well. So I suspect we're going to see upside for precious metals and miners, especially if the Fed hints at any delay in its rate hike timetable, right? But regardless of what happens to precious metals in the new year, the best solution for every investor is to stay well diversified across several different asset classes, right? We're going to head into another uncertain year. It's undoubted, right? So we've just got to be ready for anything. So don't be overweighted in, one asset class only. Be sure that you are diversified and prepared for anything. Also, we had mentioned real estate stocks. Real estate stocks had a incredible showing in Q4. And real estate investment trusts, which are some of my favorite income stocks, or they're also known as REITs, they had their best annual performance since 1976, right? 45 years since we have seen this kind of rally in REITs. And REITs are really cool because they pay out a nice fat distribution to their shareholders. In fact, by law, the real estate investment trust law, the bill that was passed back in 1963, I want to say, requires REITs, a company that sets up as a REIT, they have to distribute at least 90% of their annual income as dividends to shareholders. So they can't keep the money. They've got to hand it out to shareholders. So basically, when you own a REIT, you're getting part of the rent, as your dividends. Anyway, so REITs were really, really one of my favorite spaces. And when you compare to the S&P 500 last year, which was up about 27, 28%, and then the NASDAQ, which was up, a little less, the Vanguard Real Estate ETF, which focuses strictly upon REITs, was up, around 38% or so in 2021. Some of my favorite REITs, include things like Public Storage, which is riding the very profitable self-storage wave. Realty Income, which is known as the monthly dividend income company. Realty Income, ticker symbol O. That's one that's really been popular with the income investors. I also like several other REITs. We have one REIT in our new Smart Score 11. That's that's our top ranked REIT for 2022. And members can check that out. Just go to followthemoney.com/Smart Score 11 and see what our top ranked real estate stock is for Q1 of 2022. All right. So a lot of things we've covered, in this first segment, a lot of review of what happened in the market overall, big tech, commodities, real estate. It was a big year, energy. And then we also talked about the January Barometer. So are we going to have another big year ahead? We'll see, right? The January Barometer often turns out to be correct. And so we'll be monitoring that. But big year ahead, 2022 is here. And one of the few defenses you have against the uncertainty that lies ahead is in diversification. So not putting all of your money into real estate, not putting all of your money into stocks or all of your money into, some particular asset class. You want to have broad exposure. And that's how you defend yourself. That's how you protect yourself, in these very uncertain times. All right. So on the other side of this break, I want to come back. The largest free trade deal in history came into force on January 1st, 2022. And you'll never believe who is not in it. Stick around. We'll be right back with that info. Hold tight. The world's largest trade agreement just came into effect on January 1st, 2022. And as I said on the other side of this break, guess who is not in that world's largest trade deal? Guess who's on the outside looking in? Well, if you said the United States, you would be correct. In fact, we've been talking about this now to our students and members for several months, but this has surprisingly received very little mainstream media press. Hardly any of the corporate media have talked about this whatsoever, and we have been alerting our members about this now for some time. This is a massive new trade deal known as RCEP, which is an acronym for Regional Comprehensive Economic Partnership. And that entered into force on January the 1st, 2022. It's been over a decade in the making. And in essence, what it does is over a course of time, it eliminates tariffs on around 90% of goods, as well as introducing rules on investment and intellectual property to promote free trade. So it's a trade deal that sets up trade in Asia for Asia. Now, the Japanese government approved the deal at the end of April, and it's expected to boost GDP in that country by about 2.7% and create more than 500,000 jobs. That sounds pretty optimistic from Japan. It also, by the way, marks the very first time that Japan has had an agreement with China and with South Korea. So RCEP, this new free trade agreement, which is now the world's largest free trade agreement, includes 15 countries covering nearly 1/3 of global GDP, more than 50% of the world's exports, and 2.3 billion people. It's really astonishing to think about what this means for the countries that are involved. We're talking about Australia, China, Japan, South Korea, New Zealand, Thailand, Vietnam, Cambodia. And in fact, many of these smaller countries like Vietnam, Cambodia, Laos, and some of these others, even Thailand, are going to benefit perhaps even more than some of the larger countries, because they're going to have the ability where, a lot of businesses have moved their factories out of China, complaining about high labor costs, which is somewhat ironic, and moving to other countries like Vietnam. Vietnam has been a real popular place for offshoring companies to, find employees and cheap factories and cheap factory workers. So this is really good for some of these smaller countries that will really stand to benefit from this. And when it was signed off in January, it created a free trade zone covering about 30% of the world's GDP, trade, and population. So the fact that the United States is not in RCEP, and the fact that it's, trying to get involved in the space, but very unsuccessfully, has been fairly embarrassing, for the United States. The United States really tried to prevent China from working together with its Asian allies. I mean, they've really been trying to poison the well, if you will, as if the U.S. needs to do much. There's already a lot of ill will in the region. But the United States, of course, is aggravating that, seeking to aggravate that to their own benefit. I mean, that's what an empire should do, I guess. I mean, the empire should try to destabilize other competitors. And that's exactly what the U.S. has been trying to do with China. But nothing much here. And in fact, the United States has been trying to do some sort of digital trade agreement with India as a way to counter this RCEP. You may remember TTIP and also the TPP. These were early potential trade deals that would have also gotten out ahead of RCEP. But RCEP is now in force. January 1st, 2022, the world's largest free trade agreement, intact all across Asia. And the United States plays no role whatsoever in it. I won't belabor the fact that China has really won this decade and the previous decade, for that matter, against the United States. I did a important podcast episode last year, I believe, called Why China is Winning. Maybe it was earlier this year, but it's in our archives. Why China is Winning. I went in great detail to explain why China has, done so well against the United States. And a lot of it is just, sheer outmaneuvering of Washington. There was a report, too, several weeks ago put out by Axios that talked about China's posing a quote-unquote tremendous threat to U.S. Space domination. The Space Force leader, that's a new division of the military here in the United States, but the Space Force leader, U.S. General David Thompson, who's the second in command of the U.S. Space Force, he made some remarks on a recent interview that basically suggested that Washington had to adapt its approach to space development in order to counteract the quote-unquote tremendous threat by China in space. And according to him, China is building satellites at twice the rate of the U.S., progress. And at this rate, China could become the leader in space by the end of this decade. I wouldn't be surprised whatsoever if that's the case. China is already building its own semiconductors. It's already trying to develop, in many ways, it already has many high-tech solutions. And it's building out a lot of high-tech industries. You may recall the Made in 2025 strategy, which was very controversial here in the West, that China wanted to make things in China. So we want other countries, here in the United States, we say made in the US, USA, USA, and everybody is supposed to be fine with that. But then when China's like, yeah, we're going to make stuff in China, the United States is like, no, that doesn't work for you. That's not supposed to be something that you can say, right? That's only for us to say. You can't do that, right? You have to buy our stuff. So in other words, the point is that China is moving aggressively towards the number one position that its economy is already in. And the United States is going to have to deal with this. Will it resort to war? Will it resort to some sort of really nasty Cold War, which many people already believe we're in with China? Yeah, inevitably something's going to happen. The United States is number one, and that's almost a spiritual tag that the United States wears. It's not just number one economically. The United States views itself as number one in every way. And therefore, any crushing of that narrative by facts are going to be extremely damaging to the American psyche. And that could lead to war. There's a great book by Graham Allison called The Thucydides Trap, which talks about what happens when an emerging power confronts an established power that's waning. And that's exactly where we are today. So a war between the U.S. and China is not out of the imagination. I'm not saying that's going to happen anytime soon. I'm just saying that that's a possibility of how the U.S. will deal with it. Because again, how will the U.S. cope with being the number two power in the world? It's almost impossible for the U.S. to see itself that way, even though they're increasingly becoming number two right behind China in so many different technologies and even in total GDP on a PPP basis. But how are they going to handle it? Who knows? Right? Who knows how it's all going to play out? But war is not out of the equation. We've certainly seen it before. We could see that again. All right, friends. Well, we've covered a lot today. I talked about the January Barometer. I also talked about kind of a recap of how stocks and markets handled the last year. We talked about commodities and real estate and energy and big tech. And then we also talked about some of the new services we have here at Follow the Money. Don't forget about that. Go to followthemoney.com and check us out. Check out the plans and pricing tab and start getting our weekly reports we put out, our Robinson report, our crypto report. Start getting all of our insights so you can start really educating yourself and profiting in 2022. And then we also talked about this new RCEP, right, which is the biggest free trade deal in the world. I would be surprised if you haven't heard about it, but I would also be surprised if you said that you had heard about it, because there's been very little in the press about it. But RCEP, the Regional Comprehensive Economic Partnership, it's live, it's here, and the U.S. is on the outside looking in. And so with all that, that brings us to the concluding moments here of today's podcast episode. And as always, I like to leave you with a final word. And this time it's taken from the ancient Greek Stoic philosopher Epictetus, when he said, "He who laughs at himself never runs out of things to laugh at." And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
The information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional.